Well, it's 12:31. It's the 16th of June. So welcome everyone to the Battery Metals webinar produced or hosted by Market Matters. We're just commenting off air around the relative dress sense of the three panelists. So Peter O'Connor just told me that you, what was the comment, Rocky? You dress...
You only dress to the level of its success that you aspire to.
Okay, so there's a lot of aspiration coming from Peter O'Connor today. He's got his strong tie on. Michael Clark and I will try and keep up. Welcome again to the webinar. My name's James Gerridge. For those that don't know, I'm a portfolio manager at Shaw and Partners. I'm also the author and portfolio manager, or lead portfolio manager these days at Market Matters. We are building that team out. I'm joined by two very strong analysts, Peter O'Connor, who's with me here in Sydney from Shaw and Partners, and Michael Clark, who's joining us from Melbourne, who's also with Shaw and Partners. And today we're going to delve into the obscurity of the battery metal space, and importantly, how we're going to make some money out of ASX listed battery metals stocks. Very quickly, just for those not familiar with Market Matters, we're a daily general advice service. We send emails out to our subscribers. We've got a great website and soon to be expanded website that provides real market insight direct from the trading desk. Welcome to the growing number of subscribers that we've got on the call today. We've got actually a very large number of participants on this call today. If you're not a subscriber, we encourage you to join. We do provide what I think is some very pragmatic views around the market, and we generally help those of our subscribers navigate this rather complex market that we're all experiencing at the moment. And we're about to launch some really great features on the Market Matters website in the coming weeks, so stay tuned for those. Before we do, it would be remiss of me not to provide a disclaimer. So this is just a disclaimer that any advice provided in this call is of a general nature only, and you should consult a financial professional before taking any of the information under advice. So today's session is going to give a brief overview of the bigger picture trends, what commodities which we should be thinking about in this space. So how should we be thinking about the opportunity set, and then what stocks are well placed to take advantage of it. So, without further ado, I'm going to go straight into Michael Clark to speak about the energy transition. We've all got this, the term energy transition has been bandied around for quite a while now, but it is growing momentum. We've obviously got the huge movement towards electric vehicles, but we've also got the issues facing the other, the power grid more generally. So can you give us a sense of, how we should be thinking about this energy transition that we've been hearing so much about?
Thanks, James. Thanks for the intro. So to frame, where we're coming from, coal, gas and oil, they're fossil fuels, and they account for about 80 to 85% of the primary energy mix at the moment. So the split between the three is about 1/3 of each. And then the balance of energy systems are hydro, which is about 7%, renewables 6%, and nuclear is 4%. So coal, gas and oil, that's what we would call old energy. The energy transition is all about weaning off old energy, fossil fuels. So the way I think about fossil fuels is they're like batteries, which is where you burn them for energy, and then you get carbon dioxide as a byproduct and other impurities. So carbon dioxide is a greenhouse gas. And the aspiration in the energy transition is about getting to what people call a net zero target. So negating the amount of greenhouse gases such as carbon dioxide when you burn the fossil fuels, and methane produced by human activity. So trying to negate, so reducing emissions from energy use and also implementing carbon dioxide absorbing systems is how we'll get to net zero. So the caveat is the status quo. We're in an energy crisis because there's been underinvestment in old energy for the past 10 years. So energy as a proportion of GDP, global domestic product, which is just like the monetary value of all finished goods and services during a specific period. So that's about 15%. Energy is about 15% as a cost to global GDP, and it's usually 5 to 6%. So it's never been this high, and the fear of a peak in demand in old energy has led to the reality of a lack of supply. So we're in a situation now where we need to be reinvesting in old energy to bring pricing down to a more palatable level so you can do your day-to-day activities. But we're also going through a transition where you've got 88% of countries or the global population where you've got global emissions net zero targets. So the transition's happening. It's a done deal, whether you like it or not. You'd be negligent to be thinking it's not going to happen. And what it just means is there's going to be an increase in like lower carbon emitting systems. So electrification is a big way that plays out. So at the moment, about 22% of energy systems electricity, and all net zero scenarios that I've seen, you sort of see about 40 to 70% of energy systems being electrified.
So just on that, obviously you make the point around high energy prices at the moment, and that's driven by a lack of investment in old energy. But also, isn't that enough to incentivize us pushing down the path of renewables a lot sooner than perhaps we otherwise would? Doesn't that incentivize that level of investment, and aren't governments incentivized to deliver on that?
That's absolutely right, James. I mean, our house view is everything stays well supported from here, because it's really hard to invest in old energy, and new energy is going to be incentivized into the market sooner. I mean, the situation in Europe, how Europe's been importing, say, 60% of its gas. So gas is 25% of Europe's energy mix, and they import 60% of it. And so 1/3 of their gas imports come from Russia. And now they're trying to figure out how they can wean off Russian suppliers. So they're accelerating the transition off fossil fuels, off importing Russian gas, and they're trying to invest faster in renewables.
So what is the sticking points to investing in renewables? Is it finding, is it the commodity side to drive that? That we need to drive the development? Is it capital? It's obviously not a will. We've all got the will there, but what's the bottleneck there? Why can't it be amplified or sped up sooner?
It's just time at the end. Like, it's such a big task. I mean, we outlined where at the baseline it's about 83% fossil fuels in the energy mix now, and we're coming off a really low base with renewables. So it's going to take a generation type thing. That it's inflecting the uptake, but it's just going to take time. And then you also, when the sun's not shining and the wind's not blowing, you need a solution. And like, we're finding out, we haven't had an energy strategy in Australia for the past 20 years, and we're just starting to think about one now as a country. And we're in a situation where gas, it's been difficult to invest in gas on the East Coast for the past 10 years, but when the sun's not shining, the wind's not blowing, what's going to provide a solution through winter, through multiple months? And so it's just, I think we've tried to rush things a little bit much, and we're still, like, Australia's a real leader, for instance, on solar and wind penetration. We've got about 20% penetration on our East Coast grid there for the two of those. But you just need to keep investing. Like, the quantum is huge. We're talking here like trillions per annum globally in investment.
And storage is a real key thing, which is obviously one of the main topic that we're going to cover today. It might just be a good transition to you, Peter. Obviously, you're more focused on the commodity side. You've been in the markets, in commodity markets for more than 30 years. You've obviously seen the ebbs and the flows. We've seen a huge amount of volatility around the underlying battery metal commodities over the last couple of years. Can you just give us a backdrop of, what are the battery metals commodities? What's the basket, the opportunity set that we're focusing on here?
James, it's a pretty big basket, and if I could take the frame of reference to this discussion and go beyond battery metals, because it's really about, as Mike's talking about, the energy transition and how we do that. So it's much broader than just batteries, and I guess that's been the cliche. over the last few years. That's probably the easy way to focus the market.
It gets the clicks,
this whole
Peter. It gets the
subject.
clicks. People want to hear about battery metals.
Absolutely, but it's really about the energy transition. So within that, batteries, the key's got a cliche. Lithium and graphite have been the stars for the last 5-7 years. And it goes back to 2014 when there was this graphite boom, 2017, 2018 with lithium. But it's broader than that. So battery chemistry requires other metals as well. So it requires nickel, requires cobalt, requires manganese, it requires zinc. Then you start thinking about electric motors because we've got to run all these vehicles, and it requires rare earth elements, which is a whole separate subset. It also requires traditional base metals like copper and aluminium. Then in terms of electrification, high capacity distribution grids will require aluminium, copper, etc. And then you've got energy itself. How do we power these things? It's not just batteries, but it could be hydrogen, it could be uranium. So there's a great broad range of commodities that are at play here. So it's not just one discrete area that we're looking at.
So this is what that ties into, obviously, Clarkey talking about the extent, the huge task ahead of us. Obviously, it's not just a one-trick pony. It's not thinking about lithium as your only exposure that you should be having into this, changing dynamic. So how, can we break that those areas down a little bit more and talk about, obviously, lithium as a key component? You've talked about a lot of peripheral things, but how should we be thinking about some of those individual components?
So in terms of each of the metals separately, are you talking about where we're at?
Yeah, exactly. So I mean, so we've obviously got in the transition, there's going to be a level of construction that takes place initially. Then it's going to be about developing, large scale batteries and the like. Obviously, the electric vehicle thematic has gained a lot of traction. We're going to have, at the moment, we've got only a couple of % of global cars that are EVs. By 2030, most estimates say we're going to have about 7% of all cars on the road that are electric vehicles. How does the sequence of events take place, and how does that impact, I guess, the demand and obviously the supply response in the commodity space?
Okay, so there's two key things here, John. There's many things here, but two key things. There's the equity cycle and there's the commodity cycle, and they can be very, very different. They can move together, but they can move quite apart. We've seen that most recently in the last month or so with a lot of these names selling off. So within the broader equity cycles, and be aware, the metals and mining space is a cyclical industry. Always has, always will be. Broadly follows the global economic cycle, but also follows these big picture shifts. Most recently, we saw the China thematic from 2003 through 2008. We saw the post-GFC recovery to 2009 through to 2011. And we've seen this recovery in resource markets from 2016 through to today as well. So there's these cycles that we need to be thinking of. And within that last 7 years, we've seen graphite, 2014 to 17, had that big run in graphite stocks. The market started to appreciate the potential for graphite in batteries, in EVs. That's now retreated. And then we've seen the lithium cycle twofold back in 2015 through to late 2017. And again, late 2020 through literally a month ago. And so there are cycles within this broader construct which will continue, and they'll reflect where we're going. If I could just frame this conversation by looking at this story or the narrative going forward, we're in a broad upward channel where we're tracking in terms of the demand growth for these commodities. But we'll continue to print from an equity perspective what I call fresh new highs, which we did back in March, April this year. And we'll print fresh higher lows, which we just printed literally sometime in the last day or two. And going back the last part of this lithium cycle a few years ago, we printed a higher low then. So think about it as cycles within cycles, and that's the way you need to think. So this cycle is not over, is the key message. There will be multiple cycles. It could be built up with bottlenecks in the system. You mentioned battery construction versus mining capacity. If you get a mismatch there, you can have one or the other, see a price, a fly up in pricing that you may not have otherwise got. So there's going to be not a straight line we can draw on this, but it's going to be at multi-cycles within a broader thematic which could run for multiple years.
So I think right now we've set the backdrop that the demand for commodities is going to be high. There is obviously a known trend there. We know where we're all headed. We know sort of how to get there, and we know how much it's going to take. Things like, Clarkey, going back into specific commodities. So lithium, for instance, on your numbers, that's had experienced compound annual growth between, over the last 5 years of about 20%, and you expect that to continue right out to sort of 2030. So obviously we're cognizant of the demand side. We've just spoken about that. What about the supply response? And I bring this up because Goldman Sachs wrote a report last week that was all about the impending huge supply response in the lithium space coming out of China and other places. There's a lot of uncertainty around the outlook from investment banks, and then there's industry consultants, etc. What's your take? What should we hang our hats on in terms of the supply response?
Thanks, James. Yeah, as Rocky's saying, our messaging is to be a buyer of the sector. So especially buy dips like we've seen in the past couple of months. We think there's going to be a pricing environment that incentivizes production into the market. So an elevated pricing environment. And it looks, to be honest, like it's going to be going on for the next 5-7 years, if you look at sort of consensus forecasts. So the reason is lithium, it has unique properties, unique characteristics, and it's difficult to replicate these. It's light, but it can store large amounts of energy, and it's an excellent conductor of electricity. So it's also not at risk of substitution, which there's a few more risks around other minerals on substitution. So you're exactly right, James, about the compound annual growth rate the last 5 years, 20% per annum. Consensus looking out to 2030 is about 20% per annum as well. But it's a niche industry still. Like there's only 9 key mines in the world for lithium, 5 in Western Australia, 4 in South America, so Argentina and Chile. What our intel is, lithium is actually really hard to get right. It's not straightforward. There's no benchmark lithium price, for instance, and that's because not all lithium is equal. So it's sort of evolving as an industry, and so you've seen spot pricing for one of the battery end products, lithium carbonate, sort of move from $7,000, $8,000 a ton, and you're seeing prices in China of $80,000, $90,000 a ton US recently. And the initial price move in lithium, I think, was due to Chinese subsidies in 2016, 2017. But this is really like a demand-driven environment. So the end-use customers, the car manufacturers, they're all making commitments ahead of government targets. So they're trying to get ahead of the curve on this. And yeah, I mean, there's different forms of lithium. Just to quickly outline our thoughts, there's hard rock, there's brine, and then there's soft rocks. And hard rock in WA, that's responsible for more than 50% of global supply at the moment. So our industry channel checks indicate that that's going to continue because it's just really hard to get right in different parts of the world. It takes forever to bring these projects online.
I think it's a good point. So the feedback that I've read and listened to post the Goldman's report last week, I mean, they did move the market. There's no doubt about it. We saw lithium stocks, off 20-30% on that report. There are a few other things at play, but the industry consultants are there saying, it's difficult to get this right, guys. You're sitting in your ivory tower, not understanding the complexities that it takes to produce, lithium for battery consumption. Is that so? So that obviously creates a market that has got different views, but that's not a bad thing, Peter. I'll bring you in that. Obviously, commodities are full in the commodity markets. There's plenty of different views out there. I'm always concerned when the market is all of this one consensus view. Having different takes in the market is really important for price discovery. And ultimately, what was your take on what they came out with?
James, first, it's important to acknowledge that the markets we're talking about today, they're not commodity markets. By and large, they're what I call product markets. And that's very different because we can go to a screen, an IRIS screen or a Bloomberg screen or a Reuters screen, and we can typically get a price and look at daily copper, gold, iron ore, and we get a sense for what those markets are doing. So it's quite a transparent market. In these markets we're talking about, lithium, graphite, rare earths, they're a product market. They're all, as Mike said, very niche. There's quite different qualities across the spectrum. and there's not a specific price print. And if you can get that price data, it costs quite a bit to subscribe, and you get it typically on a lagging basis anyway, and that lag can be a day, it can be a week, it could be a month. So we're not getting real-time pricing to look at how the markets are playing out. So that's an important characteristic of these markets as well. So understanding where exactly we're at in the cycle can be quite difficult. So you talk about different views on the market. It's also different to construct what is the right price to get that view. So we need to think about that as well. But clearly, Mike mentioned the other term, incentive pricing is key to what we're in at the moment. So I talked before about cycles. Typically when markets, equities enjoy a cyclical upside, it's because supply and demand conditions are such that prices are rising for the underlying commodities. Equities typically follow the commodity prices. And right now we're seeing just that across the whole battery metals / energy transition space. Those higher prices incentivize behaviour. Mike talked about the recent uptick in prices for lithium carbonate. If a price goes from 7,000 to 70,000, it's probably going to incentivize behaviour globally to think, how could I find some material? And lithium is not hard to find. Mike made the point, it's very hard to process and get right and get the qualifications at that right quality, but it's an abundant material. So there are a lot of people globally incentivized to look, and we're in that phase at the moment. The length of that phase is about finding the product, developing the product, getting the capital, and going through that chain of production. And typically in mining, that can be 3 years, 5 years, 7 years, depending what country and what commodity you're in. But most recently, we've seen the likes of Independence Group, a recent entrant into this space. Their qualification period for a recent plant they've built has taken 2 quarters or 6 months longer than they thought. So we've got to start thinking about this type of delays as well in the system. So it's about supply elasticity, it's about incentive pricing and how long that takes. But we're in that window now where prices will continue to stay high until there's enough capacity to balance these markets.
Let's focus on the stocks for a second. So I think that's a good segue. You mentioned Independence Group, IGO. They've moved pretty heavily into the battery metal space. They've obviously got lithium. They've just taken over Western Areas. I think that deal is completed in the last couple of days. I just saw a major shareholder announcement for Panoramic Resources from IGO, which is to do with the WSA takeover. To give you some like a backdrop in the space, there's been some phenomenal gains. So even in the market's been soggy in the last year. Alchem is up 77%, Pilbara's up 62%, Liontown Resources are up 83%, Lake Resources, LKE, which is about to go into the ASX 200, is up 500%. They're now a $2 billion company. Core Lithium is up 400%. They're about to go into the ASX 200. Take us through some of these names, Peter. How should we be thinking about some of these names, perhaps led by IGO, which is a position that we've got in the Market Matters growth portfolio?
Well, this is as a segue, because I find this fascinating. Those numbers you mentioned, they're large. That's extraordinary performance. I'd love to have any or all of those companies in my portfolio. But think about Mike's comments about the old energy at the very start of this discussion. Old energy across the deck has pretty much outperformed new energy in the last 3-6 months, which is extraordinary given those diverging backdrops. But to the stocks at hand, IGO study, the basket of stocks at the bigger end of the market, and now the S&P 200 index in Australia. If I break that down into subsets, the S&P 100 component, it includes basically all new energy companies: Iluka, IGO, Pilbara, Alchem, Mineral Resources, Lynas. They're all companies related to this transition, and they're like the second tier of major companies in the Australian market. And just to focus on IGO firstly, can I say on this podcast, the deal of the decade, we're only 2 years into the decade, but IGO signed the deal of the decade December 2020. They announced they were getting to lithium, the absolute bottom of the lithium price cycle, to almost the day and the week. So they signed it on 9 December 2020. They did a deal with the Chinese company Tianqi, and they've bought into a hard rock mine in WA, the world's largest hard rock mine, in terms of production, also resource and reserve, but also a production facility to produce chemical grade lithium carbonate and lithium hydroxide.
Which is key, right?
Absolutely key. And I've mentioned before about the time it's taken them to get through that process of getting, not the build of the plant, the qualification of their product. That's a very different thing to building a plant. So we got to think as old school miners and processors, there's another step again. You've got to get qualification for these chemicals, which are very, very precise. So IGO, well-timed acquisition, the share price has largely reflected that, but their portfolio now, post their gold divestment, their addition of more nickel units in terms of Western areas. They're now a fully future-facing green energy transition company. So it's one of my key picks out there because of that breadth of their portfolio, the demonstrated track record in terms of acquiring and divesting, and the opportunities they've got to grow that portfolio as well. So it's dialed back over the last little while. It's now closest to a fair value that it's been for probably 2 years. And we'll get an opportunity to revisit that, which I think we are today.
Yeah, it's down around 20-30% from its highs, down around the $11 today. We think it's a buy down at these levels, so that's a stock certainly to look at. What about? I know you don't cover it, but Pilbara, PLS, they're a $6.5 billion market cap company. They've been long touted as the top of the lithium tree, along with Alchem, which used to be Orocobre. What's your take on Pilbara?
I like Pilbara. I like what they're doing. Can I just give you 5 rules of thumb as to what I like and what things and how to like or not like things? So firstly, the key rule of thumb is they must have a piece of dirt in the ground, and that piece of dirt's got to have something in it that is saleable, i.e. a mineral that can be sold. Pilbara has that tick. Secondly, they've got to have access to markets. They've got to have a transport infrastructure. They've got to have a willing buyer out there to take that product. In Pilbara's case, the market's running in their favour and infrastructure is not the key issue there, so tick. Thirdly, regulatory backdrop needs to be favourable. And we've seen across the globe, be it Canada, the US, Australia, countries are trying to support these industries in critical commodities, which is a huge change right now compared to what it was 2 years ago, 5 years ago. And that's going to help this transition going forward. So we've seen that in rare earths. We're seeing that broadly across the deck as well. So that's important. That will speed the delivery of these products up as well. Next is financing. You've got to have a company that can either have finance or get financing. Pilbara has net cash. I like the fact they're generating cash and building that balance sheet. And lastly, you've got to have people that you trust. Invariably with the cycle, and you get a little bit of blue sky, and there will invariably be asset stories out there which aren't really the best stories to play. So Pilbara has a product in the ground, it has access to a market and infrastructure to get there, it has financing, it has regulatory backing, and it's got the people to do it. Even though there's a change of CEO at the moment, it's got the people. So I like where they are at. And most importantly, tell me what they've dialed back in the last couple of weeks, but they're now trading at a deeper discount to their valuation than they have for probably 2 years. It's a standout in that space. It's hard rock. As Mike said, 50% of the world's lithium units come from WA. That's one of the key mines out there, and it's got growth opportunities which are quite substantial going forward as well.
Mike, there are a couple of large cap picks. Have you got any things to highlight in the smaller cap space?
I do, James. I'll just make the point as well on grade. It sort of covers up a lot of sins in mining, and the grade on IGO's Greenbushes mine is about 8 times the Chinese production ramp up that was forecasted by some other brokers. So, and we're sort of Pilbara Minerals 6 times the grade of some of the Chinese production that was talked about as ramping up over the next few years. So, that's a key one. So our message, we're trying to keep things really simple and just stick with what works now, the hard rock producers in WA. There's only 20 JORC compliant resources on the ASX, and then there's only 11, I think, in WA. So there's not many ways you can get exposure. And so we've just outlined 2 producers there. There's another producer, Min Resources. They've got 2 mines as well. And the lithium business is about 50 to 55% of consensus estimates of a Min Resources valuation. A couple of developers that look interesting, Global Lithium Resources and Liontown Resources, and they're both hard rock potential producers in WA. So they both have 2 projects they're looking to develop each. Another company we cover, which is really interesting, is what's called a Lapidalite Resource. So it's a type of mica mineral. So that's the type of rock that was talked about for the Chinese production ramping up. Now, they've been working on this technology for 10 years. The resource is in Namibia, and they're planning on processing it in Abu Dhabi. So the company's called Lapidico, and we've got a 6 cent price target. They're looking to make a final investment decision later this year on that project. And if it works, it'll be a new low-cost source of lithium. So to be clear, it's not the same as the WA hard rock, the spodumene-bearing pegmatite. It's lithium from mica minerals, and the mica mineral is lapidolite, hence the name Lapidico. But there's some of the names in the lithium space that we like. We generally try and keep it pretty simple.
So there, just to go back on that. So LTR, which is Liontown Resources, that is capped about 2.36 billion. We've got Global Lithium Resource, GL1, capped at a couple of $100 million. Lapidico is a very small, higher risk. If it works, it'll be great. If it doesn't, it obviously won't be great. So that's that just to caution everyone out there, that is a very high risk way of playing it.
Absolutely. You don't die wondering in our space, James.
The bigger end of the market, it's worth acknowledging Rio Tinto on this call. They're the gorilla. Okay. Now the lithium market needs Rio Tinto. Why? Because everything Mike's just talked about, the shortage of supply, that inelasticity. We need Rio Tinto, and I've heard this on a podcast by some of the industry experts. Rio Tinto is needed to make this market balance. Rio Tinto's got two opportunities. One's in Serbia, one's in Argentina. It'll never be a big part of Rio Tinto, so I'm not suggesting this is a reason you buy Rio Tinto, but it's certainly an interesting segue they've taken. But for a market perspective, they're in Argentina with technology which Mike can go into explain called DLE. That's an important part of that process. And in Serbia, they've got an important product which can be delivered to the European market. So in terms of market balances, we really need to have Rio Tinto to bring this market into balance at some point, which will happen over the course of the next 3, 5, 7 years.
All right, I'm going to get into some. I'm just going to share my screen because we've got a few questions, and I'll outline some stocks whilst we're looking at this. All right, so you should have IGO on the screen there. So the first question that I've got through, and we've got quite a few on the line as well, so I'll try and get to all of these. The first question is just around IGO and at what level would buy more IGO, and that's from Jan. Jan, I'll answer this by saying we've got a position, we've got a 3% position in the flagship growth portfolio. It's currently trading around 11.02. We'd be buyers at around these levels. Ideally, we'd be waiting for a dip below $10. We like buying things that go to new lows, but around $11 is reasonable value. What's your price target on IGO, Peter?
I think it's $14, James.
Yeah, so plenty of upside. I guess the takeaway here, and what I think the message that the guys have been trying to get across, and I have been as well, is around, commodities are obviously cyclical. The demand side is going to be high in the years to come, and that's going to be right across the commodity complex. There's a lot of talk about commodity super cycle, and I can understand how that is gaining momentum. And it's certainly one of the views that we hold at Market Matters. You overlay the backdrop around rising demand, etc., with the backdrop for inflation and the like, and you can understand why commodities are going to be in focus over the coming years. There's a question here, Clarkey, I'm not sure, from Wally. What's the panel's thoughts on essential metals? ESS is the code for ESSAU is the code for that. Is they've got a tie up with Tesla, fallen through, etc. I saw some announcement on it today, but it's obviously been a volatile ride. It's gone from 70 cents back to 39, but up from 10. Do you know that one, Clarkey, or not?
Yeah, they've got a resource, the Pioneer Dome, between Kalgoorlie and Esperance. So off the top of my head, the resource is about 11 megatons at 1% lithium oxide. So what that meant, the cutoff for a commercial lithium deposit, the rule of thumb is about 1%. So we were saying before, the Chinese projects are 0.25%. The good ones in Australia, 1.5%, 2%. So the resource, it appears to be good enough, but 11 megatons, you probably need 30 megatons for a commercial project to be as a resource, and so the subset of that is a reserve, call it half, say 15 megatons. So they're on the right track. They have a resource, and as I was saying before, there's not many companies. There's only 3 developers on the ASX that have got a resource in WA. So Liontown Resources, Global Lithium, and Essential Metals. So, I think it's, on the face of it, looks like a decent way to get exposure to the space, but it's not without risk, and they need to do a bit more work to expand that resource.
All right, and just to highlight, it's a market cap sub 100 million, so obviously it shows the small nature of the the company. Now, this one might be for you, Rocky. What's the preference for lithium or nickel for EV exposure? Can you give us some insights there?
Great question. I think we should have talked about nickel earlier, because nickel's important, because nickel traditionally has gone to stainless steel production. So think about your kitchen, your bench tops, your cookware, etc. That's where nickel goes. And there's an important distinction within nickel about what nickel can go to that market and what can go to batteries. And in the battery market, you need to have what they call Class A nickel, which is about half the nickel production capacity globally. So with this segment of nickel demand growing at a substantially higher rate than the underlying demand for stainless steel, there's this wedge of demand building, which is incremental. The amount of supply that's available to that is only half the nickel market. So do I like lithium or nickel more? I love the fact that Independence has got both. I should have mentioned that before, that opportunity to lever off both those two areas and have the right quality in both cases to do that. So where do we prefer? The biggest shortfall is clearly in lithium. The most expansion at the moment is clearly in lithium as well, so there will be a balance at some point. Nickel's the one that catches my eye, because most people are focusing on nickel as an old school commodity, and they're not looking at where it could be going from here. So I think nickel's a sleeper of the two, but I think probably the bigger demand story is in lithium.
I just showed Panoramic Resources on the screen there. That's obviously it's a nickel junior, which IGO is now a major shareholder following the takeover of Western Areas. There's a question just here on Neo Metals. I'm not across this one. This is from Peter. The stock has taken a building over the past month as potential groundbreaking battery recycler, with a demonstration plan up and running in Germany with collaboration Mercedes-Benz. What's the future look like here from Peter? I don't know this one, Peter. Not sure if you do, Clarkey.
I can make a couple of comments there, James. So the Neo Metals, I think they're now more involved further downstream in EVs and battery systems. So it used to be involved in the Mount Marion mine, which is now owned by Ganfeng Lithium and Mineral Resources. So that's near Kalgoorlie. But to the business, Neo Metals now, there's three business units to support the energy transition, and it's all to do with chemicals and recycling, so further downstream. So there's no question the thematic is going to get much bigger on recycling over the next 10, 20, 30 years. But ultimately, it's still a high-risk technology company, and it's very difficult to value a company that has risk around technologies. So the other thing is, like, the markets more broadly have sold off over the past couple of months, especially duration assets. So they're assets that won't be developed for a while. Yep. That's because they're sensitive to interest rate moves. So their cost of capital goes up. And so it's harder to get these assets up and going, because you need to invest capital to get a return, so to speak. So, you know, companies like Neo Metals have sold off quite a bit, as that rhetoric around rising rates has built the past couple of months.
And there's the Aussie 3-year bond yield on the chart there. That's what Clarkey's talking about in terms of rising rates. It sort of looks like a speculative resource stock, but that is the 3-year Aussie government bond yield, which we all know is ripped higher. We're trading at 3.61% as we speak. We've got a ton of questions that have come through. I'll try and get through some of these. Do we have an energy crisis because of our expectation that renewables can deliver more than possible? I think, especially in China, still has significant use of old energy. Clarkey, I think you made the comments that you made earlier, and Rocky supported this, just around, you need only look at what Whitehaven Coal has done over the past 12 months or more to see that there has been a huge underinvestment in old world commodities. And that comment was, I think, addressed by Michael and Peter earlier on. Are the new nuclear reactor technologies economic from an Australian perspective? Has anyone done the numbers on this? Now, this is from Robert. Clarkey, I know you cover Paladin. You've been at the forefront of uranium coverage in recent years. Give us a quick summation of that.
So nuclear at the moment is about 4% of the energy mix, and on average, it's about 10% of electricity systems. In the US, that's the largest source of demand for nuclear power, and uranium, it's about 20% of the electricity mix there. So there's been a lot of investment in the US, there's, it's even higher in France. China's committing to a compound annual growth rate of the higher single digits for the next 15 to 20 years. And it's only 5% of the current electricity grid in China. So, my point is, I think there's going to be a lot of investment in this space. Like any reputable net zero scenario that I've seen has nuclear power doubling between now and 2050. And that's just using existing technologies on like the existing reactor fleet. But if you start throwing in some of the modern technologies, I think you might see the compound annual growth rates globally, instead of just being 3% to 4% for nuclear power, you might see them sort of at 6 or 7%, and that's massive. The other thing to note is Russia is 21% of energy export markets, so coal, gas, and oil. What happened in the 1970s with the Arab oil embargo was where Arabic countries embargoed Western countries because Western countries supported the Israelis in the Yom Kippur War. The reverse of that is sort of happening now, that Western countries are embargoing fossil fuel producers, i.e. Russia, because Russia, frankly, it's deplorable, their actions with Ukraine. So you're going to see a lot of investment off the back of that in nuclear power. That's what happened in the 1970s. I think the same thing's going to happen again. So I think there's going to be a lot of technological breakthroughs in nuclear power, like small modular reactors, advanced nuclear reactors. You can see the US government starting to think about, so there's a fuel chain in nuclear power to get the fuel rods that feed the power stations. And what you start with is uranium, then you get converted material, and then you enrich it, and then you get into fuel rods. And the US government had Russia involved at all stages of the fuel cycle, and now they're trying to figure out how they can be self-sufficient on that. And it's going to happen, but it's not a straightforward task. Like we're talking, it's going to take a couple of decades. So I think, and where it ends up in Australia, I think we do have nuclear power. Like frankly, it's a no-brainer for Australia, but it's just going to take time. And you can see the sentiment is changing in the media ever so slightly. So the discussion is starting to happen, but the lead time is 15 to 20 years on these assets.
So Paladin on the screen there, is that the best way to play it on the ASX?
The Paladin's a really good way of playing it. Peninsula Energy is a good way of playing it. PEN's the ticker. They've got a project in the US, so exposed to the US government initiatives. Boss has an Australian project that they've gone final investment decision on, so that's going to be up and going. The other one we really like is Silex Systems. So they're involved in enrichment of uranium and further down the fuel cycle, what we were talking about before. Now, if their technology comes off, it's a genuine blue sky. The size of the prize could be anything. So last cycle, 2007, Silex was a $1.8 billion market capitalization company. At the moment, it's sitting at about 350 million, but the technology is more advanced now. And the company is looking to, I think, work with the US government on how they can use their technology to help the US become more self-sufficient. So there's a few different ways of getting exposure there, James.
Thanks for that, Clarky. Rocky, this is from Angela. Which energy transition materials are in low supply today and expected to be low for the coming 5 years? Just if you can name just a couple briefly.
Right now, it's still lithium, potentially nickel as well. We could describe a story around copper in the same area, manganese. So broadly speaking, the suite are all short the demand profile going forward. So again, prices incentivizing that behavior. But 5 years is a long time in commodity markets with prices where they are. So I'd say most will be back to a more normal level at the end of that 5 year time frame.
Thanks, Rocky. John's just asking about thoughts on Strandline. This is a mineral sands. Hopeful they're developing a mine in WA. We still like it. Clarkey doesn't cover this stock. His colleague, Andrew Hines, does, but very much likes Strandline at 32 cents. I know that's been a stock that we've covered in Market Matters. We hold it in our emerging companies portfolio, and we've covered it on these presentations in the past. John's asking, is there a replacement for old technology coal? Why is uranium not a focus? The technology has improved dramatically, and I think Clarkey has simply covered that in a really good way just before. More broadly, not just lithium, but what are your favourite stocks to play the new energy transition? That's from Nicholas. I think we've touched on a number of stocks today, but is there any more either of you would like to add?
James, I want to add a couple more. I want to add in the diversified space at the bigger end, I want to add South 32. Why? 80% of what it does now is future-facing commodities. And this is a company 7 years ago spun out from BHP, new company. It had a lot of old economy assets in their coal and other things. It's transformed. It's a new company. It's got a large exposure to all the things we're talking about today. So it has copper, it has aluminium, it has nickel, and it's manganese and also zinc, all things that are on critical minerals lists in both the US and Australia. And they're a large player in each of those markets. So I'd highlight at the larger end of the market, a very capital efficient, capital disciplined company with a great balance sheet, great management team, a lot of dirt in the ground that ticks all the boxes that I mentioned earlier, South 32. The other one is Iluka. Iluka's in the middle of transforming from a Strandline style company, a mineral sands company, producing commodities for tiles and for paint. So not really the story today, but they're segueing into a rare earth company. Really easy way to think about this. Iluka is about to shoehorn Lynas Minerals inside itself, but it's doing that with its own resource in Western Australia and government funding, which is at the highest level we've seen of any country in the world. It will become a Lynas plus an Iluka at some stage in the next 3, 5, 7 years. So what does that mean? Iluka is currently a $5 billion market cap. About a month ago, Lynas was 10 billion. Let's just say it's 8 now. Iluka is going to be 5 billion plus 8 billion at some point. And that's the growth I like in Iluka. And lastly, just to highlight copper. Copper is every single thing we've talked about today. It requires motors, it requires electrification, it requires copper. We've got a bunch of copper stock companies in Australia. I just want to highlight 2 in my area. Mike can probably got some as well. The cheapest copper stock I cover in Australia, and I think one of the cheapest in the world, is Sandfire Resources, ticker SFR, trading at 52-week low. Great quarterly coming, great quarterly delivered last quarter. Management team's first class, and they've got project pipeline to be built out. The other one is Oz Minerals, probably the best quality copper company in the world today. Best management team, great trajectory of growth pathway, primarily focused in Australia, tier 1 country, well placed, and it's a lot cheaper than it was literally a couple of weeks ago. So I like Oz Minerals as well.
Clark, any picks that you'd like to add there? I'm conscious of time. We're going to wrap it up very shortly, but if there's any you'd like to highlight.
Yeah, just quickly as well on copper. The growth rate for copper over the past 100 years has been 3.1% per annum, which is just unbelievable. So that's going to be higher with electrification over the next 20 years. So I think copper and copper developers are just it's a fantastic place to be, and they're not getting a bid, any of these stocks at the moment. Institutions don't want to put their hands in their pockets for companies that require capital for their projects. So I just reckon the space looks so cheap, and consolidation might be a thematic in the sector. Like you might see some M&A activity emerging because there hasn't been any investment in the sector for the past 10 years, and grade decline is becoming a big issue. Like Escondida that's the biggest copper mine in the world, had the lowest grade ever in the December quarter at sort of 0.7%. I think it initially started off around high ones, and
2.5.
existing 2.5, and existing producers are struggling to ramp up production in significant quantities. So copper developers, good place to be. Couple of names: AIC Mines, a growth-focused company. They've got the Eloise, so A1M is the ticker, the Eloise copper mine in North Queensland. Another one, New World Resources, high-grade copper development company in Arizona in the US, the Antler copper mine. So that's that's a restart operation. And we've got a 20-cent price target on NWC, New World Resources. And I think it's trading at about 4 cents at the moment. And we've got a 73-cent price target on AIC Mines.
I've just got a copper price, a copper futures chart up on the screen there. So we've we cover it a lot at Market Matters, just talking about copper, particularly in our macro Monday note. We're buyers back down near this $4 a pound. We did sell Oz Minerals at higher levels on valuation grounds, but we are looking to re-establish copper exposure, and Sandfire as an interesting one that Rocky has highlighted just there, and obviously Oz Minerals in terms of quality and the speculative end that Clarkey has just outlined for you. There's probably another 30 or 40 questions that or 20 odd questions that we haven't got to. So I apologize if we haven't got to your questions. We will take that on notice in the Market Matters report. So for subscribers on there, keep an eye out. We'll include some of these in the Q&A report that we send on Monday. I just want to thank Michael and Peter for joining the call today. We get some really valuable insights that we key off from Market Matters from our analysts here at Shaw and Partners. Shaw and Partners is very supportive of Market Matters. They're actually a shareholder in the business, and we lean a lot on the Shaw analysts. So thanks, fellas, for your insights today.
Thanks, James. Pleasure to be here.
And to all of those
James.
Thanks, Clarkey. And for all those on the line, very, very thankfully you've given us 45 minutes of your time. I hope we've given you some insight on the as payment for that. As I said, for those who are not Market Matters subscribers, please consider joining. We've got some great end of financial year offers coming out. We've got a very strong growing subscriber base that we hope we help navigate around the markets. I hope you have a good rest of the day. It's been a volatile one out there. The US raised interest rates by 75 basis points overnight and the market rallied. So that tells you what's built into markets already. So it's going to be another interesting 6 to 12 months ahead. So hold on to your hats, but the commodity complex is certainly a place that I think, and the guys support that money can be made. So thanks for your attention. We'll talk to you soon. Bye for now.